Hello and welcome. My name is Benoit Poliquin. I'm the founder of Exponent Investment Management and one of the portfolio managers, and I'm responsible for the EIM Partners Fund. So the fund is basically a year old. It started at the end of March of 2021. So we have 12 full months of performance. And in light of the current market conditions, I thought the sort of a video update would be timely. So thanks again for watching. As always, you can pause your video, accelerate, or slow down the video based on the charts that you want to look more closely. Thanks again for watching. As always, love to hear your questions or comments and I'll leave an email at the end of the video that you can use to reach out to me. Thanks so much. So let's start with the year-end review. It's been a tough year. The past 12 months have really been 2 years, obviously, from a calendar perspective, but also from a performance perspective. 2021 was the tail end of sort of of acceleration or almost an euphoria when it comes to investing. Some called it a bubble, and it was largely due to low interest rates and coming out of a pandemic. So central banks and government printed a lot of money, want to make sure that the economy kept going while we were all locked down at home. So how did we get here? Well, past decisions. And the net result is a supply side recession. So initially, say coming when the calendar turned over in 2022, supply side recessions are rare. Or basically, if you try to go out and buy either goods or hire workers or labor, you just can't find it. And in the absence of supply, prices rise. So labor prices went up, but also the supply of raw materials and finished goods went up as well. And we saw a rise in inflation. And so that's why I've defined it as a supply side recession. As we move forward in time, the lack of supply really, in my view anyway, and I don't want to make a political comment, but really it was due to uncoordinated and unpredictable lockdowns. And so what happens as humans when we're unsure of the future, we tend to hoard things. So we hoarded, the prototypical example of that was the onset of the pandemic, people hoarding toilet paper of all things. And so it is just human nature to sort of in the face of unpredictability, we tend to hoard things. And so you could have in many instances of basically supplies, whether it's a $2 part, a chipset, you name it, tried to buy a sofa and the fabric wasn't there, so on and so forth. There basically was an unevenness around the supply chain. Labor participation, many people quit or retired in the face of COVID, and many people could not enter the workforce to the same extent as the lockdown and restrictions came out, whether it was due to health concerns or family constraints. And central banks literally flooded the financial system with money. And so that was a bit of a challenge as well, because we were left with this. And then we also had government intervention. So whether it's checks that were mailed directly to people, loans made out to companies, small businesses, and large companies as well, there was a variety of sort of ad hoc policies that contributed to having a lot of money in the system. And this was all paid for by what is known as printing money or quantitative easing, because it's effectively money creation at its finest. So whenever you see inflation, central banks are like the Pavlov dog. They just react, and what they do is raise interest rates, and we're seeing that. And so central banks around the world started, initially at least, didn't buy into the inflation story and said it was a supply side problem. And eventually, as inflation or the data suggested that inflation was with us for a long time, central banks started talking about raising interest rates, and they're doing it quite quickly as they're catching up for lost time. And invariably, higher interest rates lead to lower asset values. And that leads to a demand side recession, which is more the conventional definition of recession, which is two negative quarters in terms of economic growth back to back. One could argue, and that we're clearly as a result of the supply side recession now into demand side recession, that the net result is that we are in a recession. And certainly the investors have that mindset, and that mindset turned late 2021, early 2022. And so this little comic strip is really the issue really around you have central banks trying to raise rates, so they're trying to sort of bail the boat, but we have governments that are basically poking holes in that strategy by continuing to spend money. And so until those holes are plugged, no matter amount of central bank actions, if you will have the desired effect or as much of the desired effect until the public spending is curtailed to, let's say, pre-pandemic levels and so on and so forth. So the U.S. markets, as we look at the U.S. markets, what we're seeing here is this is pre-COVID, is back to 2017, so a 5-year performance chart of the S&P 500. What you're seeing is the market went down basically 23%. I'm filming this video on June 22nd. And so from the peak, basically as the calendar turned over in year from 2021 to 2022, the markets peaked and we're down roughly 23%. So in basically 6 months, we've shed almost all of the sort of rise coming out of the pandemic. So we're almost back to the pre-pandemic highs, if you will. And many investors, and I have difficulty disagreeing with them, that probably we need to head back to where the economy was from a level, if you will, before the central bank and government started to spend money and pump money into the system. So what does that mean for investors? Well, the damage is mostly done, and we might be heading back towards maybe another 10%, the 3,400 level. So we're not, obviously not all, it's not a market prediction, but it's certainly a probabilistic perspective, something to consider. In Canada, this is the NASDAQ. So the NASDAQ bore the brunt, if you will, of this downside. It is down 33% so far in 2022, which is actually a bigger downdraft than the COVID downdraft. So the technology markets have really suffered the brunt of this downside. And again, we're much closer to the pre-COVID highs, if you will. And so it's entirely possible that most of the damage is already done. Now, obviously, there are some naysayers that say that we still have another, 3,000 points on 11,000, another 25% to go, but that would imply some terrible news on the economic front. If we look at Canada, the markets are down less. They're down 14% since the beginning of the year. And we're much closer to the pre-COVID levels. Now, it's important to note that the Canadian market, the TSX, really has hovered around 16,000 plus or minus for the better part of a decade. So coming out of COVID, it was the first time in a long time that we were seeing levels above 18,000. Europe is down 24%. Obviously, the war in Ukraine didn't help, and they're having other issues as well because they're net energy importers, as we know, commodities and energy in particular have spiked since the beginning of the Ukrainian war or conflict or war, and so the European economy is suffering, and the European consumer is suffering even more than North Americans, as continental Europe is a net energy importer. Now, typically, if you're a bond holder and in the face of market uncertainty, the bond prices tend to rise. But this time around, it's been quite the opposite. So here we have, just for illustrative purposes, we have the benchmark 10-year bond. So that's a Canadian government bond coming due 10 years from now. So in 2030, well, basically the beginning of December 2031. So a little less than 10 years. And the price of this bond basically peaked in December. And since then, the price has gone down 17, almost 18%. So if you're a bondholder and you have a balanced mandate, your stocks suffered some damaging. Now we are moving over to the portfolio directly. So if we look at the portfolio, we are looking at, as of the date of recording, June 22nd, we have 4.4% in cash, which is a higher than usual cash balance, and it reflects our cautious stance, if you will. 33% or a third of the assets are in Canada. The Canadian portfolio is really what we call Canada. Like to call it the land of oligopolies. So basically, all the large economic actors. There's very few of them. There's, two rail companies. There's, depending on how you count them, five large charter banks. There's four telecom companies, three food retailers, so on and so forth. And so what we try to find are the best of breed, if you will, in each of the sectors. The weights, when you're looking at the weights, we tend to put about 2 to 3% in terms of the portfolio weights. That would be a neutral weight. When we're trying to enter a position, we would do it in stages. We call it layers. So we would layer in. So in case of the banks, we're waiting for lower entry points. And so we've kind of layering them in, if you will. And then larger commitments in terms of stocks are either down or overly cheap or overly sold off, we will tend to have weights around north of 4 towards 5, north of 3 towards 4, and then even 5%. And so you can see that there's a lot of companies like 3M, Activision, and Walt Disney that are high conviction names. Overall, the portfolio, and then we move on to, in terms of allocation, we have maybe another 40% in the US and another 23-25% in outside of North America, mainly in Europe and China as well. And so that rounds out the portfolio. The yield on the portfolio is 2.88%, which is roughly equivalent on what you, or close to what you would get on a 10-year bond, say, in terms of equal duration. The portfolio itself, we continue to position it for not only a recession, so things like utilities, things like grocery stores, companies that tend to do well in slowing economic activity, or other companies that kind of have a lot of pricing power. So think of video game makers. You can think of obviously banking, or companies that provide a solution like 3M, or cereal makers like General Mills. And then the next bucket, if you will, or next sleeve of names are companies that are getting ready, or we're trying to add positions for. The nice thing about bear markets is that the economies do turn around. They don't last that long, and so you have to think about the names that you want to own for the next economic recovery. So you've got a sleeve for recession, a sleeve for a longer, sort of more protracted, difficult economic time, and then finally the third sleeve of names are for the after recession, if you will. So that's how the portfolio is constructed. If we move over to performance, through the end of May, the performance, or the one-year performance, is flat. And if we compare that to the indices that are down substantially, if we combine the US, Canadian, and European indices, those return net of fees about almost down 9%. And net of fees, the fund was down basically flat. We lagged a little bit on the sort of longer term number of 5%. You can see the shorter term numbers were well ahead of the benchmarks. We tend to be more defensive. As a firm, we tend to do better in down markets. And we can explain the underperformance, if you will, is because earlier on, as I mentioned at the top of the video, the markets were very, very hot, and we were reluctant to chase them. And so we really stayed true to our valuation discipline. You can see that 2022, in terms of a relative performance, was much better than 2021, and that's to be expected of most new funds. So let's look at 2022 and beyond. What does that take us? Well, what hasn't changed? Our dividend focus. We want companies that share the wealth, share a portion of their profits. There's two ways to make money in investing. One is appreciation, and the other is receiving income from your investments. We want to have quality balance sheets. Companies for whom a recession or rising interest rates, will not threaten their very existence. We want to see proven management, both their ability to share the wealth, or by way of dividends or share buybacks, but also in their ability to navigate difficult economic times and to also capture opportunities. The global approach, we'd like to see companies, and we focus on companies that have a global footprint. We don't want to overpay for assets. As I said early on in the life of the fund, we didn't want to chase the market, and that continues to be so. We really want to get a good handle on what we think the asset is worth. And we want to stay away from headlines. We don't want to chase headlines. We don't want to be influenced by headlines, which really means we tend to buy stocks or sectors or particular names that are, they might be in the headlines, but for all the wrong reasons. And we just want to make sure that all the bad news is baked in and then some. And very often we will be selling companies that are in the headlines for all the right reasons. And so you want to buy stocks when no one wants them, and you want to sell those same stocks when everyone wants them. Some of the adjustments we've had to make, well, we had rising interest rates. Obviously, is a question of inflation transitory, meaning will it fade away, or it will be a permanent story? That's something that we need to adjust to. Consumers, the impact on housing and inflation on consumer discretionary income. Consumers are 70% of the North American economy, so it's important to understand that we have to adjust to those. Um, Working from home, hybrid models has led to a hollowing out of downtown cores all over the developed world as people basically, there was no reason to be downtown anymore. And that has an impact on housing prices. It also has an impact on family formations and so on. And they all drive consumer spending. The K recovery is also something that we're monitoring in demographics. So K recovery refers to the difference between the upper strata socioeconomically that have done well out of COVID. They own assets; those assets have gone up. Their jobs are more they call them the Zoom class, and so really the income um, generation ability was not really impacted by the lockdowns. Now, the lower strata socioeconomically don't own any assets. They're mostly renters, and rents have gone up. And B, they're more in the service areas, and so that impact has had impact on their ability to earn income. And finally, demographics, the aging population is still something that we need to respect as well. We feel the recession is already upon us. It will be short. So the impact to your portfolio, we feel the higher rates will be here for a period of time. Will continue, but those rates should subside. We feel the acceleration of higher interest rates should subside by the end of 2022. Global growth is rebounding as the world reopens, but it's uneasy, it's lumpy, it's clumsy. So you have China that is still following a COVID zero approach. Southeast Asia is kind of a mix. Europe is reopening, but then we'll be closing for obviously the August holidays. So that's going to have an impact on economic data. Asset bubbles are deflating. We showed you the stock prices. They were down, pick a number, anywhere between 15 and 30%. Housing has not turned over, but it seems to be wanting to turn over both in Canada and in the US. In a bear market, quality companies also sell off. So we feel it's often a time to upgrade. So even though you don't really want to take a loss on a particular position, you may want to take that anyway because it's an opportunity to buy a company that is perennially expensive and under the guise of the bear market has sold off substantially. And you want to have a focus on recession resistant names in industry. It doesn't mean the stocks won't fade or sell off, but it just means that their businesses and their ability to resist or get through a recession is not hindered, meaning it'll be around for a while in terms of its future success. We also want to have companies that are actually taking advantage of the softness, whether buying up weaker competitors or grabbing market share. Now, many clients will ask me, how do bear market end? Well, you need three components. Always those same three components show up. So you have low valuations. We're not there yet. They're not extremely low, but they're certainly much lower than they were 6 months or even a year ago. We have low expectations. We're definitely there. If you look at most of the investor surveys, extreme pessimism around investing. Everyone's calling for more downside. But you also need a catalyst. So the catalyst usually is central banks at least stopping to raise interest rates. And sometimes you need, or central banks will announce a new round of lower interest rates or quantitative easings or some sort of impact on interest rates, lower interest rates, that is. And if we don't get this catalyst, usually bottoming is a process. And so you have markets that kind of move around. It wouldn't be unexpected to have markets stick around these levels plus or minus 10% for a while until we have this catalyst, which may be interest rates stopping to be increased by central banks, probably in uh, the fourth quarter of 2022. It could also be a change in political. So we have elections in the U.S. coming in, so just a change in policies or political climate. As always, thank you for watching. If you have any questions or comments, please feel free to drop us an email. Thank you again for watching.